Great. So thank you everyone for joining. We're going to talk a lot about financial aid and affordability planning tonight. We'll go through a lot of material, but hopefully it will all kind of tie together and make sense. So let's get started. So we're going to be talking about two major topics. One of them is assessing where you might get aid. And you, in this case, really means the student. And then the other part is deciding what you can afford. And the you in that case is typically the parents. Understanding where you might get aid is a matter of identifying the student's profile and understanding whether the student might qualify for need-based aid and or merit-based aid. We'll talk about both of those a lot. And then the second critical component is once you understand the student's profile, making sure that the colleges that the student is putting on his or her list have a good prospect of awarding to students with that profile. Deciding what you can afford is making sure that you understand the true total cost of college. That's the net price of a four-year degree if you're looking at a bachelor's. You want to make sure you understand the resources that you have available to pay the cost. And typically that comes from savings and income. You want to make sure you know if you're going to have to borrow, and if you do have to borrow, you want to make sure that the amount of debt is reasonable. Now, it's a good chance that people will have questions as we're going along. If you can put them into the chat, we'll address questions at the end of the presentation. So when most people think about the cost of college, they tend to focus on what you might call the sticker price. That's the starting cost. And at USM, that's about $25,000. At University of New England, it's $61,000. At Bowdoin, it's about $80,000. And at BC, it's about $84,000 per year. But it turns out that colleges award a significant amount of gift aid. That's financial aid that does not need to be repaid. And that actually lowers the true cost, which is called the net price. So the net price for students who receive aid at USM is about $12,000 a year. At UNE, it's $39,000. Bowdoin, it's $23,000. And BC is about $33,000. However, not every student receives gift aid. At USM and UNE, the vast majority of students do, but at Bowdoin, 48% of students are paying the full sticker price, and at BC, 58% are paying the full price. So when you count those 48 and 58% and look at the average net price for all students, you can see that it ranges from about $13,000 at USM to $39,000 at UNE, about $51,000 a year at Bowdoin, and $62,000 a year at Boston College. So the point of this is to highlight that it really doesn't matter what colleges charge. What matters is what you pay. And what you pay is your net price. That's the college's cost of attendance minus the gift aid that you might receive at that college. So when you think about financial aid, there are really two major categories. The first is gift aid. That's free money, and that actually reduces the cost of college. Typically, if it's based on financial need, it's called a grant. If it's based on grades, test scores, and things like that, it's called merit aid, and that's usually labeled a scholarship. The other category of financial aid is self-help. And this is financial aid that doesn't reduce the cost of college, but helps to manage the cost. And there are two main types of self-help. One of them is work-study. So that's a campus job that the student gets during the academic year. The other is loans, money that you borrow for college and have to repay after college with interest. So when you think about financial aid this way, it's pretty clear that gift aid is a lot better than self-help, and that's what you really want to focus on when you're thinking about the cost of college. Unfortunately, colleges don't necessarily make it easy to distinguish between them. So this is a financial aid award letter. An award letter is how colleges notify students and families of how much financial aid they're going to get. And if you look at the bottom line, it says that the financial aid for this year is $22,000. Well, that's great. That's a lot of money. But when you look at the award letter more closely, it turns out that of the 7 line items, 4 of them are gift aid, 2 of them are loans, and 1 of them is work study. When you subtotal those different categories, it turns out that the gift aid is about $15,000, the loans are $5,500, and the work study is $1,800. Now, $15,000 is a lot of money, but it's not nearly as good as $22,000. And there's some important information missing, such as the list price or the starting cost and your true cost, the net price, which is the starting cost minus the gift aid. I went online and looked it up at this particular college, and it turns out that this total starting cost is a little under $50,000. When you subtract the gift aid of about $15,000, it turns out that the net price for 1 year at this college for this student is $34,865. So keep that number in mind. We're going to come back to it later on in the presentation. But first, let's talk a little bit more about the different types of gift aid. So we said there are 2 main categories of gift aid. One of them is need-based aid, which is typically called grants. That's based on the family's economic resources, and that's measured by their income and their assets. You apply for gift aid at all U.S. colleges using the FAFSA. The FAFSA is required for gift aid at all U.S. colleges, and it's also required for federal student loans. In addition to the FAFSA, about 150 colleges have an additional application for financial aid called the CSS profile, and they use that to award college-funded aid. Now, there are over 2,000 four-year colleges in the US, so it's really a fairly small number that require the CSS profile, but they tend to be the best-known colleges, and they tend to be the ones that are most generous with need-based aid. So if your student is applying for need-based aid, there's a good chance you're going to encounter the profile. The other type of gift aid are scholarships. This is merit aid. It's aid that's based on the student's academic achievement. So things like grades, test scores, class rank, the classes that the student has taken, and so on. Now, this is often awarded automatically when the student receives an offer of admission. So they might get an admission message that says, "Congratulations, we want you to come to our college, and we're going to offer you $10,000 per year in scholarships." However, some scholarships do require additional applications. So what you want to do is once your student finalizes the list of colleges that he or she is going to apply to, make sure you go to the financial aid page of each college and understand exactly what you need to do in order to qualify for the most aid possible. So let's talk about need-based aid first. Need has a very specific definition in the financial aid world, and this is the algebra portion of the evening. So need is COA minus EFC or SAI. I'm going to explain those acronyms in a moment, but what you need to understand about need is that is the maximum potential eligibility for need-based aid at a given college. It's not necessarily how much your student is going to receive in need-based aid. And in fact, it rarely turns out that the amount you receive is equal to the amount of need. So COA stands for cost of attendance. That's the college's starting cost or sticker price. And the cost of attendance is always made up of 4 things: tuition and fees, housing and meals, books and supplies, and then transportation to and from campus and other miscellaneous expenses. EFC stands for Expected Family Contribution. That's really a pretty misleading term because it makes you think when you read it in English that that's how much you're going to pay for college. And it rarely actually is what you end up paying for college. And for that reason, the FAFSA has changed the term EFC. It's now the SAI, or Student Aid Index. And all it really is a way of ranking all of the students who are applying for financial aid at college in terms of the economic resources that the student and the family have. Now, as I mentioned, colleges award aid differently, and college aid policies vary, ranging from colleges that meet no financial need to colleges that meet full need based on the FAFSA SAI or the profile EFC. So if your student has high financial need, you may want to be identifying colleges that are likely to meet that need with gift aid. Now, people always wonder, will they qualify for need-based aid? And the formulas are very complicated. So there's really no cut or dry threshold that will say, yes, you'll qualify, or no, you won't. But here's kind of a guide to kind of what ballpark you might be in. So in 2022, the median income for a household of 4 people was about $109,000. That means that half of the households of 4 people had income less than that, and half had income more than that. The median wealth in 2021 for all households, which includes all financial assets, home equity, retirement, was about 167,000. So that's, again, half of the households in America had less than that, half of the households had more. And it's generally to people in the lower half of those economic spectrum who are likely to receive the lion's share of need-based aid. Now, that doesn't mean that if your income or assets are above that, that you shouldn't apply, but it does make it increasingly less likely that need-based aid is going to really be the full answer to your paying for college questions. So we said that the EFC or the SAI determines eligibility for need-based aid. The lower the EFC, the more eligibility for need-based aid. And there are 2 formulas to determine eligibility, one based on the FAFSA and one based on the profile, but they both use the same basic approach, which is to look at the income and assets of the parents and the student. Now, when they do this, they're actually coming up with 4 subtotals in the background, and they add the results of each of those subtotals to come up with that final EFC. One thing to point out, for most people, income plays a much greater role in determining the EFC than assets do. Once you reach a relatively low threshold of income, each additional dollar of income reduces eligibility by about 53 cents. Once you reach a certain level of assets, each additional dollar of assets reduces eligibility by 5 to 5.5%. So income in general plays a much bigger role. They typically also do a similar process with students. Most high school students don't have significant income that's likely to influence the EFC, but some students do have assets in their name. And if they do, that is going to reduce eligibility for aid more than those assets would if they were in the name of the parents. So if, for example, a student happens to have assets in his or her name, one loophole you can do to potentially qualify for a little bit more aid is to put those assets into a 529 owned by the student. If you have $1,000 in student assets in the student's name, they're going to reduce eligibility for aid by $200 to $250. But if you put them into a 529, they're only going to reduce eligibility for aid by $50 to $56. So that's a loophole that potentially could be a little helpful in qualifying for more need-based aid. So let's talk a little bit more about the FAFSA and the profile. And I want to talk first about what the FAFSA is for. The primary purpose of the FAFSA is to allocate federal student aid. And federal student aid, the most generous federal student aid, are Pell Grants. Pell Grants go to the neediest students only. So typically families whose household income is 30 to 40,000 would qualify for a Pell Grant. Once it gets above 50 to 60,000, it's quite unlikely. Most state need-based grants are also based on the FAFSA, as is federal work study. However, even though work study technically is a need-based aid program, at many colleges, campus employment is available to most students, even if they don't have financial need. Another important thing that the FAFSA is used for is federal student loans. In order to qualify for federal student loans, all students must file the FAFSA, and as long as they're citizens or green card holders, they will qualify for federal student loans regardless of their income. So Bill Gates' family would qualify for federal student loans, as would a very low-income person. And at colleges that don't use the CSS profile, the FAFSA may also be used to award college-funded grants. However, it's important to keep in mind that most colleges that don't use the profile tend not to be particularly generous with college-funded need-based aid. And what that means is they often leave a gap, often quite a significant gap, between the amount of need and the amount of aid. So that's what the FAFSA is for. What is the profile for? The profile is used to award college-funded need-based grants. And most generous need-based aid comes from colleges that use the CSS profile. At those colleges, the maximum annual aid based on the FAFSA is about $7,000 to $10,000, while the aid based on the profile could potentially be as much as $80,000 or $90,000. Now, many profile colleges discount the EFC if there are multiple siblings in college, which means that each sibling might qualify for more aid. One term that you hear in the financial aid world is the idea of full need. And almost all colleges that meet full need with aid use the CSS profile. Now, many of these colleges say that they're need blind, which means they claim not to consider whether a student has financial need in making admission decisions. Some of those full need colleges, though, are need aware, which means that at the margins, students whose family are able to pay the full price may have somewhat of an admissions advantage. So a lot of people say, well, should I apply for financial aid if it's going to reduce my student's chance of admission? And I think you probably should, because you really don't want your student to go to a college if you can't afford it. So you want to be able to qualify for as much aid as possible, in my opinion. Now, almost all colleges that don't meet full need are need blind. So this concept of need aware really applies to only a very small number of colleges. So let's compare the FAFSA and the profile, because we said that they're both looking at income and assets. So exactly what income and what assets are quite important in determining eligibility for need-based aid. So starting with the FAFSA always starts with adjusted gross income from the tax return, and then they add back some items of income that aren't taxed for tax purposes, but do count for financial aid. And the most common of these are deductible IRA and SEP-type retirement plans that are shown on the 1040. In addition, they also count tax-exempt interest, IRA distributions that are not rollovers, and pension that might not be taxed. Common FAFSA assets include checking and savings account, mutual funds, brokerage accounts, real estate other than the primary residence, which means investment real estate or second homes. Family business or farms are included. Parent-owned 529s for which the student is a beneficiary are included as an asset. And assets are always valued at the market value, less any debt directly secured by the asset. So if you have an investment property, then it's valued at the market value using something like Zillow, for example, minus any mortgage debt on the property. Retirement accounts and personal property are not included as assets. So the profile is going to look at all of the income that the FAFSA looks at, and in addition, they're going to look at retirement contributions to 401ks and 403bs that are reported on W-2s and not on the 1040. They will look at tax losses and depreciation that are allowable for tax purposes, but are not considered cash flow items. So they will add those back as untaxed income. The profile also includes untaxed Social Security and gifts from other people, including payments for college. Common profile assets include all FAFSA assets plus equity in the primary residence. That's the biggest single difference between the profile and the FAFSA. The profile also looks at parent-owned 529s for which the student's siblings are the beneficiaries, and they typically look at assets in the names of the student's siblings. Once again, assets are valued at the market value less the debt directly secured by them, and neither the FAFSA nor the profile include retirement accounts or personal property. Now, you may have heard that the FAFSA has changed recently, and it has. It took effect last year, so for kids who graduated from high school in the class of 2024. Like the profile, the FAFSA used to offer a discount when there were multiple siblings in college at the same time, but that was eliminated last year. When the parents are divorced, the rules for which parent provides information changed for the FAFSA. It used to be that the parent with whom the student lived was the parent who reported their income and assets. Now, the person who is the contributing parent, which means the parent who reports their income and assets, is the parent who contributes the greater share of the student's expenses. If the parent who's the contributing parent has remarried, the FAFSA will also look at the income and assets of the new spouse. Now, as a result of the changes, very needy students benefited. About 500,000 more students qualified for Pell Grants with the changes. And overall, about 3/4 of students had a lower SAI using the new FAFSA rules, which meant that they had higher eligibility for need-based aid. So when we're talking about need-based aid, we should talk about some special cases. I already mentioned when the parents are divorced, there are some special considerations. And as we said, the FAFSA is going to look at the contributing parent only. That's the parent that contributes the greater portion of the student's support, plus that parent's spouse. Now, the profile is going to look at both biological parents of the student, the custodial and the non-custodial parent, And if those parents have remarried, they will also look at the income and assets of the new spouses. So the profile may be looking at the income and assets of as many as 4 different parents and step-parents. They do some calculations that are intended to put the primary burden on the biological parents, but those calculations are imperfect. So it's often disadvantageous if the parents have remarried. So if you're thinking about remarrying, do it for love, don't do it for financial aid. Another thing to keep in mind is that the FAFSA and the profile are looking at income that was earned in the past. And that means that if your financial circumstances have changed, you might want to consider appealing for additional aid based on special circumstances. So for example, if you've lost a job, if there's been a death in the family or something like that, you may want to go to the college. You'll have to report things as they actually occurred, but you want to go to the college and say, hey, the information on my FAFSA or profile doesn't really reflect my current situation. Can you evaluate and potentially give me more need-based aid? Another thing that people sometimes do is, and I'm going to put it in quote, negotiate for more aid. That's basically asking the college to review their offer of need or merit aid outside of hardship in order to request more aid. Now, whether the college is going to grant that is going to depend on the circumstances and how persuasive a case you can make. They sometimes do and sometimes don't. And once again, it really depends on the college and the college's competitive position as to how open they may or may not be to reviewing aid and potentially increasing it. Another thing to keep in mind is that early decision is often a disadvantage for financial aid. The reason is that early decision is an agreement that the student and the family make, and they say, we will apply early to your college. You will let us know early if the student is admitted, and if the student is admitted and you offer enough financial aid to make it affordable, we commit to going to your college. The disadvantage here is that you are unlikely to have competing awards from other colleges, and those competing awards are often the basis for asking for more aid. Once you make a decision to commit to a college, you are supposed to withdraw all of your applications from other colleges so you won't have competing aid offers to compare. So let's talk about the dates for the FAFSA and the profile. And remember that they're looking at both income and assets. Income is going to be looked at on a calendar year basis. And for students who are seniors this year and graduating in the spring of 2025, they're going to look at income that was earned during the calendar year 2023. So this is income that you earned last year. You filed your taxes April 15th. Your student is probably getting ready to apply to colleges this fall, which means that you'll be able to apply for financial aid this fall. And when the colleges notify the student of whether they've been admitted, then hopefully they can also let you and the student know whether the student will qualify for financial aid. Assets are valued as of the date that you click the submit button on the FAFSA or the profile form. So for example, for students who are going to be graduating this year and are applying this fall, you'll be valuing assets in a few weeks based on the time that they're applying to college. And that means that there's a little bit of planning that you might be able to do to potentially increase eligibility for aid. Now, as we said, assets count less heavily than income does in the financial aid formulas, but they do count. And so if you can reduce the amount of assets you're reporting, there might be some additional eligibility for need-based aid. So if you have some expenses that you know you need to make, for example, if you are self-employed and you make estimated tax payments, it might be advantageous to make those tax payments, those estimated tax payments, a little bit earlier than you normally might. That way they won't be in your bank account when you report the value on the FAFSA and the profile. So this is a summary of the dates that are going to be in effect for all 4 years of college for students who are going to be graduating this coming June in the high school class of 2025. And you can see that for their first year of college, they're going to be looking at income from 2023. For the second year, they're going to look at 2024, the third year, 2025, and the fourth year, 2026. Well, it turns out that 2026 is the calendar year that's going to end when the student is a sophomore in college. That means that the final profile or FAFSA will be based on income that was earned a couple of years prior to college graduation. And again, this can potentially offer a planning opportunity. So if the student is fortunate enough to have a relative, maybe a grandparent, who wants to help pay for college, for the CSS profile, payments from grandparents will count as income to the student. So it could be advantageous to wait until after January 1st of the student's sophomore year of college for the grandparent to make those payments. That way, the final income year for the profile will have passed, and the amount of those payments won't be counted for financial aid. Now, if the student is going to a college that doesn't use the profile, you don't need to worry about it. And if the student is not receiving need-based aid, you don't need to worry about it. But that's one example of where the timing could be beneficial. So I've got tables for juniors, sophomores, and ninth graders. And once again, I'll have my email up at the end of the presentation. If you request the slides, I'll be happy to send these to you. So let's say that you have checked and you think that your student might qualify for need-based aid. What you'd like to do in that case is to identify colleges that might meet that need. Well, when a student has financial need, there are 3 things that the college can do. The college might meet that need with a grant, with gift aid. That's the best thing. They might meet some of the need with loans or work study. That's second best. Or they might not meet that need at all. They leave a gap. The aid that they offer is less than the need. That's something that you would prefer to avoid if possible. So let's look at some schools and see what how they stack up in terms of meeting need with grants and what their gaps are. So at Orono, they typically meet about 48% of need with gift aid, and they leave about a 26% gap. 26% of the need is not met with gift aid or loans. What that is saying is that Orono doesn't have a really generous need-based aid program, but Orono is probably still going to be affordable for most Maine residents because of its lower starting cost. At UNH, they also don't have a very generous need-based aid program. They have a much higher starting cost than Orono for a Maine resident, so that may not be a great place to look if your student needs need-based aid. At NYU and Ohio Wesleyan, they meet a greater portion of need with gift aid, but there's still a significant gap. And NYU is notorious for not having very generous financial aid, Ohio Wesleyan actually does a much better job than NYU. And then BU and Bowdoin have more generous need-based aid programs. So BU meets 84% of need with gift aid. There's a 10% gap. And Bowdoin is kind of the gold standard of meeting need with gift aid and having no gap. So they meet 90%, 97% of need with gift aid. So that's great if your student has financial need. So let's say that you have need and that you identify a college that might meet that need. Will the need-based aid make college affordable? That's a critical question. So I'm going to show you an example of how a generous full need college awards need-based aid. So this college has a starting cost of $72,000. They meet 100% of need, and the EFC in this example is $30,000. So you subtract $30,000 from $72,000, and there's $42,000 of financial need. The college is going to meet 100% of the need, but it's going to meet the first $4,500 with a loan. Then they're going to meet the next $2,200 with a work-study offer. And only after making offers for loans and work-study will they meet the remaining need with gift aid. So even though the EFC is $30,000, the gift aid is, or the net price after gift aid is almost $37,000, so $7,000 more than the EFC. This pattern continues in years 2, 3, and 4, and you can see that the gap between the net price and the need, and the EFC, increases. So at the end of 4 years, there's been a cumulative EFC of $120,000, but the 4-year net price is $33,000 more at $153,000, even though the college has met 100% of need. And this is a generous college. It doesn't include inflation. So my rule of thumb is if your EFC times 4 plus about $40,000 to account for the need that's met with loans and work study, if that EFC times 4 plus 40,000 is not affordable, then need-based aid may not be the answer for you to find an affordable college. But if need-based aid isn't the answer, then maybe you want to think about merit aid. So to talk about merit aid, we really need to step back a bit and think about the business of college. So when students and families typically think about college, they usually focus on the acceptance rate. That's the percent of students who applied to a given college and were offered admission. At Harvard, it's only 3%. Claremont, McKenna, and BU are 11%. And Muhlenberg, Ohio Wesleyan, and University of Denver are 50% or more. Well, colleges, of course, pay attention to the acceptance rate, but they also look at another number, the yield rate. This is the percent of students who were offered admission in the spring and who end up enrolling at that college in the fall. At Harvard, more than 4 out of 5 students who are offered admission end up going there. At Claremont, McKenna, and Northeastern, about half. About a third end up going to BU. But at Muhlenberg, Ohio Wesleyan, and University of Denver, it's 15% or less. Now, when that yield rate is less than 20% or so, colleges really start to worry about having enough students making a contribution to their overall tuition revenue to help pay their bills. So what do? They put themselves on sale with financial aid. So much like a car dealer needs to empty the lot when the new model year comes out, colleges need to make sure that they fill their seats in the fall. So they discount their price with financial aid in order to compete for yield. This third column shows the percent of students at a given college who received college-funded gift aid. Now, that gift aid might be need-based aid or it might be merit aid, but the point is that it's free money that reduces the cost of college. And the fourth column focuses specifically on merit aid. So merit aid is, by definition, not related to financial need, and it's offered based on grades and test scores in order to attract students to that college. And you can see that some of those colleges with lower yield rates use significant amounts of merit aid in order to attract students to come to their college. So merit aid is typically called scholarships based on things like GPA, class ranks, the curriculum the student has taken, test scores, and so on. It's most prevalent at private colleges, but a lot of public colleges are using it now too. And here's a key point. The highest awards go to the strongest students relative to the other applicants at the school, which means that you might find that the safety schools for admission are also safety schools for financial aid. And once again, college aid policies vary. Bowdoin and Harvard use zero merit aid, and other colleges use it extensively. So I want to show you some examples of how colleges awarded merit aid, and these are from before the pandemic when SAT scores were much more widely used. And you can see that at each of these three colleges, their highest merit awards corresponds quite closely to the 75th percentile SAT score. The 75th percentile SAT score is the cutoff between the lower 3/4 of the students who applied and the upper quarter of the student. And the lower merit awards correspond quite closely to the 25th percentile. So these are the bottom 25% of applicants at the schools. So you can take this and make a pretty good generalization, which is if a college uses merit aid, the best chances for the best awards are when you're above the college's 75th percentile compared to other applicants. If a college uses merit aid, the awards may phase out when you get to about the 25th percentile. But at many colleges that compete aggressively for students, they may award merit aid to nearly everyone they admit. So which colleges award merit aid? This, I think, is the single best way of identifying whether a college uses merit aid. And you can go to this link. It's maintained by the federal government. It's called College Navigator. You look up in the financial aid section to see that institutional grants or scholarships percentage. That's the percent of students who receive college-funded gift aid. At Gettysburg College in Pennsylvania, it's 95%. Only 5% of the students at Gettysburg are paying the full price. At Lewis and Clark College in Oregon, it's 100%. Nobody is paying the full price at Lewis and Clark. So here's kind of the generalization. If that percent of students receiving college-funded gift aid is over 65 to 70%, it's pretty likely that the college uses at least some merit aid in its aid awarding program. If it's over 80%, it's highly likely that the college uses merit aid. So where might you get merit aid? What I want to show you is an example of a student who's got an 1180 SAT, that's equivalent to an ACT of 24. And you can see a lot of SAT statistics in the US News and World Report program or publication. So at Shenandoah University in Virginia, their 75th percentile SAT score is 1260. Their 25th is 1060. That 1180 is right in the middle. So this student is probably going to be in the top half of the applicants at Shenandoah, and likely to get one of their better merit offers. And if you look further in this section of US News, you can see many other colleges where this student's SAT scores are competitive, and so therefore might make this student a candidate for a decent merit award. Now, if there was a silver lining to the pandemic, it's that many colleges have gone test optional these days. And so your student may not be planning to submit scores. What I often do is make up a proxy SAT that I think is consistent with the student's grades and transcript, and use that number as a way to identify schools that might be likely to be good candidates to offer the student merit aid. Another really valuable data source is called the Common Data Set. It's not as user-friendly as some of these, but it is has a wealth of data. And to get to a common data set, you want to Google the name of the college you're interested in and then the words common data set. Now, in my experience, about 2/3 to 3/4 of colleges publish their common data sets, and it's a huge compilation of data of all kinds that they report to US News, the College Board, and so on. So if you can find it, you want to look for merit aid in section H2A and look for data points N and O. N is the number of first-year students who received non-need-based aid, in other words, merit aid. This is Hofstra in New York, and about 24% of the students there received merit aid without having financial need. The average award was about $24,000. Hofstra's cost is about $75,000 to $80,000. So that means that you might be looking, if your student gets an average award, of maybe $50,000 to $55,000 a year. So let's look at some other examples of merit aid. BU uses merit aid, but not very much. Only 49% of their students receive college-funded gift aid. 51% are paying the full price. So if you're looking for merit aid, BU may not be the best place to shop. On the other hand, at Dickinson and Fordham, only 6% of those students are paying the full price. So if your student gets an average award at Dickinson, they might end up having a net price of about $58,000. If they get a typical award at Fordham, they might end up with a net price of about $69,000. And you can do the same thing for public colleges too. If you're looking for merit aid, don't look at UC Berkeley. Not going to get it at Maryland either, but you might well get it at University of Rhode Island or Arizona State or the University of Maine. So to summarize, the best chances for merit are when the college has a high admit rate, a relatively low yield rate, a relatively high percent of students who receive college-funded gift aid, and the applicant is strong relative to other applicants at that school. So here's a summary of how colleges award need and merit-based aid. And you can see that I've grouped colleges into 4 categories, which I call elite, near elite, mid-market, and other. The elite and the near elite colleges, these are the famous colleges that you've probably heard of. They tend to be quite generous with need-based aid. They meet full need often and nearly all of it with gift aid, but they use little or no merit aid. On the other hand, the mid-market colleges may not be as generous with need-based aid, but they tend to use quite a bit of merit aid. There are probably about 100 to 150 colleges in that elite to near elite category. There are about 2,000 colleges in the mid-market or other, which means that if you're looking for merit aid, there's a good chance there are a lot of colleges that would like to recruit your student and might offer a discount to do that. Okay, so we've talked about need-based aid, merit aid, how colleges award aid. Now I want to give you an idea of how you can estimate your net price. And the way to do it is to go to a college's website and look for their net price calculators. Net price calculators are required by law. All colleges have to have one, and they are required to tell you the college's starting cost, the amount of gift aid, and the net price after subtracting that estimated gift aid. Now, even though all colleges are required to have a net price calculator, they're not required to have a good one. And here's how you can tell the difference. If it has 5 or 6 questions, you can finish it in 15 seconds or so, it probably stinks. If it has a lot of questions that replicate the types of questions that are going to go on the CSS profile and the FAFSA, if it asks about grades and scores and so on, then it's probably asking for enough information to give you a pretty reliable estimate of what the net price might be at that college. Now, it's always going to be an estimate. It's not guaranteed, but it will give you some indication of where your student might qualify for some discounts. So when you use net price calculators, what you're going to be able to do is compare the net price side by side so you can make an apples to apples comparison on the basis of price. Here, I want to pause for a minute because we've been talking about dollars and cents, the financial aspect of it. And there's more to picking a college than that. You want to ideally find a college where your student is going to have a good learning environment, where they'll have a social environment, where they'll have fun and thrive. So I'm not advocating that you find the cheapest possible college. What I am advocating, though, is that you make sure that whatever college your student attends is going to be affordable for you and your family. So let's look at some examples of net prices to compare on an apples to apples basis. And we're going to look at a student with an EFC of 15,000, B minus to B grades, and an 1100 SAT. At Roger Williams in Rhode Island, the starting cost is 64,000. The student might get 21,000 a year in a merit offer and an additional 1,000 in need-based aid, making for a net price of 42,000. At Shenandoah in Virginia, it looks like a net price of about 34. At Wheaton College in Massachusetts, about 30,000. At Orono, it might be 29,000. Bowdoin is great, about 17,000, so only 2,000 more than the EFC. And at USM, living with your parents and commuting, the net price is about 15,000 a year. So a couple of things to point out. First, I know that commuting from home while living with your parents and going to USM is not the same as going away and living in the dorm. But the reason that I put that on here is to remind people that there is an affordable path to college for everyone. It may not be the college that you've dreamed of, but far better to make some compromises during the 4 years of college to get the benefit of a college degree that you can afford and not be burdened with excessive debt for decades after college. The other thing to point out, a B minus student is probably not going to be admitted to Bowdoin. So even though Bowdoin has a great net price, you don't want to put all your eggs in that basket. Okay, so now let's say that you've gotten to the net price and you want to think about how do you pay for it? Well, a lot of people say, well, I hear that there are tons of scholarships out there just waiting to be claimed. And in most cases, that's probably not true. In my experience, the lion's share of financial aid to pay for college, 90 to 95%, comes from the colleges themselves. And those scholarships that you might apply to, they take a lot of effort to find. They may require essays to apply to them. And they typically end up being for $500 or $1,000 or $2,000. Now that's great. That's money that I'd rather have than not have. But when you're talking about a college that might cost $50, $60, $80,000, that's not going to go a long way to offsetting the cost. The way you pay for the net price of college is from income that has been earned over time. What do I mean by that? Well, there are three sources of income. One of them is prior income, so money that was earned in the past and saved. Another is current income, money that's earned during the college years and can be used to pay for college expenses. And then the final source of income is future income, money that's earned after college and is used to repay debt that you took on to pay for college with interest. Paying off loans with future income is always the most expensive way to pay for college. So let's ask, is the net price affordable? And I'm going to go back to that award letter we looked at the beginning of the evening. We said that the net price was just under $35,000. We've got to remember that the cost of a degree is going to be over 4 years, and that's just the 1-year net price. So we've got to ask a couple of questions. First, how much will costs increase over the course of the 4 years of college? And really important, is the aid automatically renewable and on what terms? Now, typically, need-based aid is renewable each year as long as you file the FAFSA and the profile, and your income and assets remain pretty consistent over time. Merit aid is typically renewable over the 4 years of college, but if it's not crystal clear, make sure you ask for each item of aid on the award, what is required to renew it, and is it renewable for all 4 years? So we're going to assume that the costs increase 2% per year and that the aid is renewable and constant for 4 years. We're also going to assume that the student has $2,000 in savings and the parents have $25,000. So how do we pay for this 4-year degree? Well, when you take $35,000 and inflate it over 4 years, the cost of a degree is about $144,000. We're going to assume that the student gets a work-study job each year and makes $2,500 each academic year that he or she can use to offset some of the costs. And we're going to assume that the student will take out federal student loans. If you're going to borrow for college, federal student loans are always the first place to look because they're automatically available as long as you file the FAFSA. The rates are reasonable for an unsecured loan, and there are protections for the borrower if he or she runs into trouble after college. But there's a limit to how much you can borrow. It's $5,500 in year 1, $6,500 in year 2, and $7,500 each in years 3 and 4. So that's a total of $27,000 over the course of 4 years. Next, we're going to use those $2,000 in student savings. Remember, when we were talking about the EFC, we said that assets in the student name reduce eligibility more than assets in the parent's name. So let's spend those first, and maybe there might be a little bit more eligibility for aid in years 2, 3, and 4. Next, we're going to assume that the student gets a summer job each year before college. And if the student gets a job that pays $10 or $12 an hour for 40 hours a week for 10 weeks in the summer, he or she will make about $5,000. They'll pay taxes, go to the beach, but they should still be able to save $2,500 each year for college. At this point, we've got to start looking to the parents. And these parents look at their budget and they say they can afford about $375 a month out of their ongoing income to pay for college during the college year. That's about $4,500 per year. Next, we're going to use $18,000 of savings, and that fully pays for year 1 of this college. In year 2, we're going to use the balance of the savings. It's another $7,000. But at this point, the family's resources are exhausted. The only way to pay for additional college is for there to be additional borrowing. And I always consider any borrowing beyond federal student loans to be a parent responsibility, because at a minimum, the parents are going to need to co-sign for those loans. So to fully pay for this college, the parents are going to need to borrow $12,000 in year 2, $19,000 in year 3, and $20,000 in year 4. At the end of 4 years, we have fully paid for this college degree using prior income, current income, and future income. There's $27,000 in student debt and about $52,000 in parent debt. Is that a good idea? Well, we don't know yet. And the first question we need to ask is, what will federal loans cost? Student loans are currently charging 6.5% interest and parent loans about 9%. And they're paid off over 10 years, beginning 6 months after graduation. When you borrow for college, the interest clock starts ticking immediately. And so the amount of interest that builds up during college is going to be added to the beginning balance of the loan when it goes into repayment 6 months after graduation. And it turns out that for every $1,000 of student debt at 6.5%, the student is going to have to pay back $136 per year for 10 years. So this student is going to have about $4,600 of accumulated interest. Add that to the $27,000 he borrowed for student loans. That means the beginning balance is $31,622. 31.622 times 136 is about $4,300 a year that this student is going to need to pay every year for 10 years in order to repay his or her student loans. The parents are going to need to pay about $9,400 per year. So is that reasonable? Well, my rule of thumb is that for a student, payments for education debt should not exceed about 10% of the student's gross income after college. So if the student is paying $4,300 per year, the student then needs to get a job that pays about $43,000 a year. That way, the student will have 90% of his or her income for taxes, rent, and everything else, and then can use the remaining 10% to pay off those student loans. And the good news is that new college graduates, on average, make $40,000 to $50,000. So in my opinion, borrowing that amount for college is probably okay in return for the benefit a student gets for a college degree. It does put some constraints on the student, though. If the student wants to work for Greenpeace for $20,000 a year, well, that's going to make it hard to repay those student loans. For the parents, it's a more complicated question because they've got to think about their ongoing obligations, college for other children, and retirement. And in this case, I see a big red flag. So we said that these parents looked at their budget and decided they could pay $375 a month or $4,500 a year. If they feel they can pay $4,500 a year out of their income during the college years, what makes them think they can all of a sudden go to $9,400 a year out of their income to repay those loans after college? So to me, this does not look like an affordable scenario. So this is pretty heavy stuff, and a lot of people ask, how does everyone else pay? And the answer is exactly the way we're talking about tonight. So you take that college's cost of attendance, the starting price, minus the grants or scholarships, and over 4 years, that's the 4-year net price, the true cost of a college degree. You need to match that with the resources that are available to pay the net price. So every student can get $10,000 over 4 years in summer earnings, $10,000 in work study, $27,000 in student loans. Add to that what the parents might be able to come up with out of savings or income that's earned during the college years, and that amounts to the total resources that are available to pay for a 4-year college degree. If the resources don't equal the net price, the only options are to either take on more debt, and I consider that more parent debt, or find a college with a lower net price. So what I recommend to all families is to identify what I call your zone of affordability. What that means is looking at those 3 sources of income: prior income, current income, and future income for the student and the parents, but with a very important caveat. I always exclude parent debt from this initial look at affordability. I want to find out how much the family can afford without parent debt. And then I'm going to look at the 4-year net prices of colleges, and colleges whose 4-year net prices are equal to or less than the total amount of resources excluding parent debt are what I define as that zone of affordability for that family. Now, obviously, every family is different, and parents can choose to take on some debt if they wish. It mounts up very quickly, so my advice is to be extremely cautious with it. And it's helpful to know what that parent debt-free point is, so that if you are taking on debt, you're doing it with your eyes wide open and with a high degree of confidence that you can pay it off. So once again, this has been some pretty heavy stuff. I often think about it in terms of the stages of grief. And I would much rather have you go through the stages of grief now while your students are in high school than after college, when either the student or the parents may have taken on too much debt. Another thing to keep in mind: college is important, but it's not the goal. The goal is to set the student up for success in life after college in a way that neither the student nor the parents have excessive debt. Another way to keep this in perspective is to think about some pretty successful people and look at where they went to college. So Howard Schultz, who built Starbucks into a giant company, went to Northern Michigan University. Bob Iger, the CEO of Walt Disney, went to Ithaca College. And Michelle Buck, who's the CEO of Hershey Foods, went to Shippensburg University in Pennsylvania. These are all fine colleges, but they're not the top of mind colleges, those kind of brand name colleges that you might think of at first glance. Another way to keep it in perspective is to look at the dollars and cents. So a graduate of Boston College in their mid-career might make about $1,000 per year more than a graduate of Loyola University in Baltimore. So not a big difference, but the 4-year net price differs by $108,000. So in other words, it would take that Boston College graduate 108 years to make up the extra money that they paid on average for that BC degree. So how can you find financial safeties? You can go through the numbers in the same way that we've talked about tonight. And that's what I do when I'm working with families. There's kind of an easy shortcut way too, which is to seed the student's college list with colleges that have different approaches to the way they award aid. And it's likely that some of them will end up being affordable for you and your student. So it always makes sense for people from Maine to apply to one of the UMaine campuses. You might think about an out-of-state school. But if you think about some of the secondary ones, it might be significantly less expensive. So Worcester State is about $23,000 a year less than UMass Amherst. If your student has high need, some of those highly selective private colleges might be a good bet. And if your student might benefit by finding colleges that use merit aid, the group, the colleges that change lives, is filled with colleges that use a significant amount of merit aid. And if finances are really tight and constrained, a commuter school is always an option. You get the benefit of a 4-year degree without having to pay for the $10,000 to $15,000 a year in room and board, and that can be a great alternative. So finally, I want to leave you with an idea of how you might get some free money to pay for college. If you contribute $1,000 a year to a 529 account administered by FAME, they will give you $300 a year of free money. So even if your student is already in high school, even if you've only got 4 or 5 years before he or she graduates from college, you might get an extra $1,000 or so to pay by starting to contribute to a 529 account. So I've got some links on my website to resources that hopefully will help with some questions that you might have. And we do have time now for questions. So let me ask you to go to the chat and put any questions into the chat. And meanwhile, I'm going to stop the recording